Let's talk about an under-discussed management and business metric, which is return on equity. This will be very interesting if you're, well, even if you're just personally investing in the stock market, or if you're a CFO and you've got some extra cash sitting around your business and you need to put it somewhere, so you're going to invest in an outside company, or you're just looking at your own company versus one of your competitors. Okay, please note this is general information. The business environment's always changing. Always check on what's current. This is not business investment advice. This is strictly to learn about how return on equity works. Return on equity, owner's equity, or just equity, is the total dollars invested by the firm's stockholders. So it's the assets of the company minus the money owed to other people, so debt. Return on equity is the earnings divided by equity. So it's like comparing miles per gallon among cars. So if you're going to buy two cars, you may look at the MPG on the two cars and you say, okay, this one's more efficient than that. It's the efficient use of money invested. And it's just like the MPG in cars, more MPG is better. It is one measure of how well management is doing. So if you're giving management a lot of money, how do you know how well they are utilizing your money to make more money? This is what we're talking about. So we have two firms, Firm A and Firm B. They are both in similar industries. They both make about $15 million in after-tax earnings. So here's Firm A, here's Firm B, after-tax earnings, 15 million, 15 million. So which firm is the better investment? You got to go out and you got to buy stock in one of these two firms. You got too much excess cash sitting around in your company. You need to invest it. You've been told to invest it. So how do we know? How do we know looking at this data? Well, it's not really possible to know from this, is it? So what if we add some more information? Firm A has 100 million in owner's equity. So that's over here. And we've added owner's equity, and Firm B has 300 million in owner's equity. And again, both are in similar industries. So now which one would you choose? And why? Well, let's see. Here is where this return on equity becomes an interesting and useful tool. We calculate earnings on equity. The ROE on Firm A is 15 million divided by 100 million, which is 15%. And on Firm B, 15 million divided by 300 million is only 5%. So now which is better? Well, getting $15 interest on $100 invested, or getting $15 on 300 invested, which would you rather have? So yeah, ROE is a lot like interest on a savings account. The higher the interest you get back, the better. But we said that A and B are in the same industry, but what if they're not? Or what if they have different risk portfolios, different risk profiles, I should say? Can we still assume that Firm A is the better investment? Well, let's look at the risk. What if Firm A is smaller than Firm B? Smaller firms have more risk. What if Firm A is in a high-risk industry? So maybe they're in the same industry, but they are taking higher risk. Maybe they're doing something, a new process in their factory or something like that, and it's higher risk. What if the Firm A received a one-time windfall? So they won a lawsuit, they had some policy change in government, and now they are earning money just because of that one-time thing. Or what if they had a serious management change after those numbers? Yeah. So the lesson here is always consider data in context within the current situation. It is easy to jump back to the original situation and say Firm A, Firm B, you can't tell. Then you look at the next thing and you say, okay, well, 15 on 100 is much better than 15 on 300, but context. Okay, short video, but very useful information if you're going to be in executive management or if you're investing from your company into another company. Okay, next topic.